Good afternoon, ladies and gentlemen. A very warm welcome to you on Business Today Television. We start Monday, which is the second fortnight of September, on a mild back foot. There's no issue at all. The first 2 weeks have been wonderful. In all, about 630 points is what the Nifty has added in the previous fortnight. And Monday starts with a mild sign of red, but across the board there are many stocks that are doing fairly well in September. Remember, the GST rejig has happened. You've had a very good monsoon. There is the rate cut via the RBI, which is working into corporate India, and of course the income tax rebate. All of them are now coming together to have this very good macro, and let us see how the markets are reading it. Joining us is Mr. Nitin Bhasin, Head of Institutional Equities at Ambit. Namaste Nitin ji, a very warm welcome, and as always it's such a pleasure to host you. For our viewers, please explain how do you see sentiment at Dalal Street at this point of time? The macro seems to be working well, but it's the earnings which have disappointed equity strategists such as you.
Thanks, Ananda, for having me here. You're right. Where the government is doing all its bit with the income tax and the income tax adjustments around the budget, following it up with the GST changes very recently, ahead of the upcoming festival season consumption and good monsoons, as you rightly mentioned. But the trends that we saw in the beginning of the fiscal, which was a poor earnings growth for Nifty 50 or Nifty 100, which continues to hold. And whether it is earnings expansion through from margins, or earnings expansion through exports, or earnings expansion through consumption trends in India, pretty much it's like 2 steps forward, 2 steps backward. Two sectors do good, two sectors don't fire. So hence, in that context, it's pretty surprising that that the market is holding up, which speaks that how much is the flows holding up the market, because this is one of the earnings which is the weakest earnings we've seen in years in India, which clearly shows that the Indian capital investor, which in the last 12 months rolling basis may have brought in 55, $56 billion, is providing a huge amount of support to the market, which is rock steady now for the last 5-6 months at around these levels of 25,000 Nifty. So hence, that's how I read. Earnings continue to remain under pressure with no meaningful near sight for it to turn around.
Nitin ji, there will never be 100% case for equity. We will always continue to have 2 or 3 nitpicks into the system. At the current position, it's the sheer lack of earnings and the fact that the market has run up very well. In 2025, we are in the 9th consecutive year of gains.
Yes.
Against this backdrop, what are you recommending your institutional clients? What should they be doing? Institutions, by and large, at least the foreign ones, have been net sellers.
Yeah. I think it depends upon who you are, where you can, what are the opportunities that you have. For the Indian retail investors, as many of our fellow experts have mentioned, that India has moved from a consuming class, saver class, to an investor class right now. So what you're seeing, a lot of flows coming into the equities in India, and you can talk to any corporate and they will say capital is not a challenge in India anymore. So hence the question then arises, as you rightly mentioned, Shailendra, is where to park that money. And we see that it's been closer to 12 months now. We've been highlighting to the investors, especially institutional investors, that in their asset allocation, they should be looking at large caps relative to mid caps or small caps, and especially more stark to small caps. And if you look at the current year to date also, it is the Nifty or the Nifty 100 which have outperformed the mid cap and the small caps perhaps not generating. So this is what we're advising to institutional investors and to even the individual investors, that if you are looking at index-based investing or cohort-based or market cap-based investing prefer the large caps. And that's played out in the recent earnings season also. The June quarter, the large caps earnings stood. I think I would say that's the first thing. But though 1 year back, we were pretty much saying that one should be overweight banks. That's not the thing that what we've been highlighting now for the last nearly 2 months or so, since about June, that mid-June or so, that, one should be actually looking at more relatively moving our clients in the mutual fund industry, asset allocators. They should be more about IT. They should be more in sectors such as FMCG. They should be more in the sectors such as pharma/healthcare compared to banks. Perhaps banks are going to go through earnings downgrades. We are seeing some of the banks go through that earnings downgrade cycle. So I'll pause there to highlight and again summarize. It's the large caps that we like. It's the small caps that we would say avoid. It's the IT and the FMCG followed by pharma that we would like.
Okay. Nitinji, let me just address the elephant in the room, which is the IT sector. Now on your top radar, between the time we spoke last time, I think this was 2-3 months ago, and now there has been two important developments. June and August, my apologies, July and August, about an 11% fall in the index. And just in the fortnight gone by, Infosys announcing its largest buyback ever, 18,000 crore rupees. Now, for a stock picker like you, and as you mentioned in your earlier comments that large cap is what we are telling our institutional clients to focus on, where does IT fit in? Very nice valuations, a lot of drop in stock prices, and now this buyback kicker. What is your view?
Sharadji, that's what the last couple of months what we've been highlighting is that market reacts to the trajectory of earnings estimates and perhaps the starting point of valuation in which you enter. What we saw is in the early days of July, post the earnings, a lot of earnings reduction in stock price reactions also. And hence we said that from here onwards, the earnings estimate trajectory will have least amount of cuts for IT. Perhaps could have more cuts for the banks. And if you think about it, that's the simple framework that we used. And because of which, the stock price reductions, etc., we said, people will start finding in the mutual funds what next sector to actually think about or rotate their money in. And IT features amongst the top one or top two sectors for me. But let me give you a full disclaimer here. If you were to talk to IT analysts on the street, including ours, they may see that valuations are expensive compared to pre-COVID and post-COVID. Earnings growth are different. But think about it, the whole world has changed pre-COVID and post-COVID. Valuations are not the same because of the flows, etc., what has happened. What we are saying is, IT may not be the place to own for 5 years. That's not my recommendation is, but IT at least is the place to own for the next 6 months. And within that, we said TechM, Infosys, to some extent Cognizant, these are the kind of names is what we like amongst the large capish names. So I would say those 3 names.
Okay. Nitinji, now I am going to drag you into a controversial part of the market, and I am going to force you to give us an answer.
Sure.
There are 2 schools of thought as far as this Infosys buyback is concerned. One says, आप 18,000 करोड़ रुपए खर्च कर रहे हो अपना शेयर खरीदने में, इसको R&D में डालते, पहले नहीं डाला, चलो कोई बात नहीं, आज डाल देते. We could have something fantastic in terms of a product. Second school of thought is कि this is an IT company, it refuses to learn from its past and is now walking towards the sunset. It's doing best what it can, return money to shareholders. आप इसके बाद पैसा हमसे लेके किसी AI कंपनी में लगा दो, जो आपको करना करो, हमारे बस की नहीं है. We can only return money to you. Now, as a market watcher of 3 decades, where do you stand? Do you want to look at the past via a buyback, or do you want to look at the future?
Uh, I think interesting question. This sort of debate happens every day, Sharan. And I would say that I agree with both the stances, and both of them are fair. If you were to say as an analyst, I would say for sure. You are a company, Indian IT services, huge amount of cash flows. But why should I only pick up on the Indian IT companies? I think so many companies in India have not invested in either a capex or R&D. As a country, we may have not actually approached that. So I think Infosys has lived through the times of the day where our country was. I think you can look at the R&D expenditure by the corporates in India as the least. So perhaps they were doing what the society around us was doing. So I would not actually go out and say that I'll judge them for that. But remember, at the same point in time, Infosys keeps on doing small and small capital allocations. R&D, acquisition, buyback, dividend. Shananda, these are all avenues of capital allocation. Clearly, Infosys today is at a maturity stage. Perhaps unlike many of the growth companies in the country who are looking to allocate capital abroad to buy mega acquisitions, we've heard about them. They are not perhaps signed up or thinking like that. So they're doing the best as a mature company or doing buyback because they may be looking at all the opportunities of acquisition available to them. Remember, they announced one recently. So they must be thinking, such large sums of money, we don't know in our site, which make return on capital employed of more than our present return on capital employed. So they're allocating over there. So every management will do what their wisdom. I can't go back in the past and say why they didn't do it. Perhaps nobody in our country or most of the people in our country didn't do it.
Yes, I think there is this burden of thought which a lot of long-term observers in the market have. Infosys raised its Nasdaq listing somewhere in 2001 and raised money from people like you and me to fund an acquisition. वो आज तक नहीं हुआ. That money is lying is a fixed deposit in State Bank of India, and year upon year, this debt-free company generates tons of cash and is having a bad ROE because cash barely fetches you anything. Anyway, I get the gist that you are on both sides of the argument. Perhaps Infosys's management and its board of directors no longer have the power to fight the world just as they had in probably 1996, 1995. Be that as it may.
But Sharendra, I'd like to add over there. Remember that
Please
they're
do.
answerable to their shareholders. If tomorrow they were to announce a $3 billion or a $10 billion acquisition in India or perhaps outside India in a product business, how would the Indian shareholders look at them? And how would their shareholders say that you have track record to build that? So remember those two things, that they're answerable to shareholders.
Nitinji, I am telling you, each and every one of them will applaud. They will say, चलो देर आए दुरुस्त आए. देखिए, एक आईटी कंपनी का काम है फोर फ्रंट ऑफ टेक्नोलॉजी पे रहने का. जैसे कि 90 के दशक में, 2000 के दशक में हमारी आईटी कंपनीज थी. अब ये तब निम्बल फुटेड थी, अच्छे तरीके से 50%, 25%, 30% ग्रो कर रही थी ईच ईयर. आपने वो ज़माना देखा है, आपने ट्रैक किया, मैंने भी रिपोर्ट किया उस पर. अब तो ये हाल है कि इन लोगों की ग्रोथ हमारी जीडीपी ग्रोथ से कम है. और वो ज़माना था जब इन्फोसिस वाज अ ग्रोथ स्टॉक. अभी ये ज़माना है कि समझ में नहीं आता कि इन्हें कहाँ रखें. एनीवे, चलिए इस डिस्कशन में बहुत समय ज़ाया होगा, कभी आमने सामने बैठेंगे तो इस पर चर्चा करेंगे. नितिन जी बताइए, व्हाट नाउ? जीएसटी रीजिग इज इन प्लेस. You have automobiles screaming at record highs. M&M, Maruti, TVS Motors, Eicher Motors. These are all consumer plays. Within the ambit of Ambit, what is a top auto pick?
I think something like an Eicher motor or an Ashok Leyland makes more sense. I would say, my recommendations would largely be very closer to what my analyst recommendations are. So I would say Eicher hai, Ashok Leyland hai, at the same point in time, perhaps Hyundai hai. These sort of companies, they make sense, perhaps. from the auto, where we are skimming buys in the auto space. But I'll also add that, it's not clear to me that whilst the GST actually saves the near term, it is a one-time bump up, Sharendra, for the whole demand in the near term. The bigger question that I would answer is, would there be a lot more job creation and income growth? Because we would like this trend to continue. So hence, in the near term, these are the three names that I would actually look at. Though Ashok Leyland could be different for different reasons, and I would have a different thesis, but Hyundai and Eicher, to some part, fit into that thesis.
Okay. And in the same pattern, Nitinji, auto ancillaries will do immensely well. Many of them over the last 6-8 months have done a phenomenal rally in markets, whether it's Gabriel, whether it's Banco India, whether it's Subros, all of them have given supernormal return to investors. Is this a space that interests analysts at Ambit?
Yeah, I think we do cover about half a dozen to three-fourths of a dozen auto ancillary companies. We may not be covering the names that you mentioned, but others like a Bharat for Happy Fortune or the Motherson Group, etc. So I would say that auto ancillaries can't be painted with the same brush, because all of them have different business models. Somewhere some people are acquiring companies in India, some are acquiring outside India, some are EV plays, some are premiumization plays, some are actually recovery plays. So clearly, it's a more bottom-up story to be in auto ancillaries. Globally, the whole transmission space, the whole platform space is changing for the auto ancillaries. So hence, just to say, like the autos, where we can say GST will benefit two-wheelers or four-wheelers, one more than the other. In this particular case, I think it's a very, very different space, because companies are very, very different from each other. So hence, I would rest my case at that in terms of auto ancillary. Be selective, find companies where promoters are focusing on more technology-dependent product development. And over there, they're also nimble-footed, the word that you used, to look at how to acquire clients both in India and abroad. One should not be only India-focused. One should be more globally focused. How do you add into metallurgy more plastic and even electronics? I think that should be the framework to look at auto ancs.
Okay. Nitinji, we would like you to share your understanding of the NBFC space. Bajaj Auto hit a record high today. My apologies. Bajaj Finance hit a record high today, and that's presented as one of the best plays for this four-pronged trend that is in the market. GST cut, a cut in interest rates, a nice monsoon, and of course the reduction in interest rates. What is your view of the NBFC space, and any favorites that are there on your radar?
So, disclosure, my analyst covers Bajaj Finance, and we have a sell recommendation for our clients, and we definitely are.
A sell reco?
We're getting it wrong, our recommendation wise. But clearly, in a country where credit growth is very weak, and the banks are struggling perhaps also to grow mid-teens to high teens, and this is a company with Bajaj, they're going out and they're acquiring customers, launching new products, perhaps are positioning themselves for the new avenues of demand for credit across the country. And hence they are one of the best performing companies in the country. They're using technology, they're finding new gaps of credit, and also are continuously posting a very good ROA. Perhaps market hence keeps on surprising them over there, because the whole banking space, you can see the private sector bank valuations, how they have corrected over the last 2-3 years. And today, not many NBFCs are scaling themselves up, and many of them, the newly listed ones, whether it is an HDB or the others, are very Me Too sort of companies. There's no differentiation over there. Perhaps Bajaj Finance hence is trading at these valuations, defying valuations concerns, despite their ROEs moderating from a high 20% to mid 20%, 28 to 25. It is defying, perhaps standing out as one of the best plays. I think if I was to extend this conversation around the NBFCs, I think the one should look at companies perhaps more in the gold finance, I would say. They make sense today. Could be
Absolutely.
where unsecured lending comes under pressure. Gold financing companies could actually appear attractive in the marketplace today. Add to that one of the contrarian stocks. We like to look at stocks which are down 50, 60, 70% or 30, 40% from their highs, and where the outlook looks hazy, but the compared advantage over a long period of time looks good. Some of the companies, such as five-star microfinance, may have 2, 3 quarters which are very weak, but beyond that, I don't think so. They have lost any compared advantage. Good management, good business model, and a gap in terms of credits in India that they are actually going out and meeting. So, hence, I would say that's a stock which has come off sharply. One should be looking at that. So, those are some recommendations I would say. The ones which nobody is talking about, the microfinance space, the one which benefits in the near term or so from the high prices of gold in the gold lending space. Those would be the ones that we like right now.
Okay. Uh, Nitinji, the other black spot in the market, not really a black spot, but a weak spot in the market has been defense companies and PSU stocks. The last, 3 or 4 sessions have been good to them. Is there value emerging for an institutional research outfit such as yours in the PSU segment? Anything that catches your eye, defense in particular? What are your views at the institutional end?
I think defense reminds me of an opportunity of the 2000s of perhaps defense and certain renewable stocks, renewable sectors. These are those thematic sectors. Even to some extent, even electronics, I would say. These three thematic is that the new India is getting built. It is like the 2000s of technology or 2007 8 of real estate and power, and 2013-14 of NBFCs. These are those sectors which are thematic. People are talking, valuations are giving, valuations are not, perhaps based on fundamentals, that more based around narratives. So I would say we cover very less of electronics companies, barring a few, one or two. We don't cover any defense companies. And at the same point in time, very few renewable companies. We find valuations of the sector not that conducive, barring a few examples here and there. Please don't take that every company is expensive and no company will make money. What we are saying is, at a generic pack wise, we find these three sectors more valuations away from fundamentals, perhaps what these companies can achieve in the next 2, 3 years.
Okay, Nitinji, time draws to a close. Next time we'll be having you over and we'll discuss the portfolio of the model portfolio of Ambit Institutional Research. We look forward to you joining us again for a wonderful discussion. Thank you for your time.
Thanks for having me. Thank you.
That, ladies and gentlemen, was Mr. Nitin Bhasin, the head of institutional research at Ambit Securities. Thank you for watching.